Can we just start with a quick show of hands? How many here are from Indiana?
Wow.
Okay, any from New York? So just kind of a challenging city for the three of us to be in after that series. But we do wish a lot of luck to the Pacers. So my name is Jeremy Shore. I am a senior investment partner at Sella Direct Ventures. We are an Italian-based financial firm with a multi-hundred-year history at the holding company level. And included in our business is direct investing into both venture funds and companies off of our balance sheet, as well as having a bank, a digital bank, financial district, traditional fund to funds, etc. And could not be more excited for this panel today, where we're really going to dive into this fairly opaque world of family offices and venture, this two-sided marketplace, where unfortunately sometimes it's really hard for the two to actually connect, and it could be even harder to identify where families can be the most strategic LPs. However, it's this person's view that they are in fact the most strategic LPs. And so we have an incredible panel that the folks at GEC, who we're thrilled to have been invited by, have asked me to introduce. So I'll start going to my right. Immediately, Kay Makishi is a vice president at Lupoff Stevens Family Office. So as I mentioned, based in New York, and they advise on investments as LPs into impact-oriented early-stage VC funds and founders. Kay is also, very interestingly, an ambassador for Invest Tokyo, which is a U.S.-Japan she's a U.S.-Japan council member, board member of Oxford Alumni Association of New York, advisor to Mount Sinai Innovation Partners, advisor to various VCs and startups, mainly in the U.S. and Japan, and a former operator, founder, and turned VC and LP. To Kay's right, Annie Ueda serves as managing director at Carmody's Capital, a single-family office investing in early-stage venture, and located right here in Indianapolis, rooting for those Pacers. And Annie is a third-generation family office member. Annie brings to this conversation and to her work a unique perspective to early-stage investing, which has been informed by her own entrepreneurial journey, passionate about fostering greater representation of women in VC, and Annie is dedicated to really encouraging more women in the industry overall. And to Annie's right, really happy to welcome Louis Shibata, who is a former world-class figure skater, turned next-gen principal at her family office, also a third-generation family office member, where she plays a key role in direct investments in mission-aligned VC funds, spanning areas of impact, wellness, real estate, culture, entertainment, and emerging markets. Louis is a Columbia University alum, a nonprofit founder, and brings cross-border experience from living in Asia, US, and Europe, and has worked across VC, high-growth startups, and investor relations. And Louis enjoys speaking on values-aligned investing, next-gen perspective, and women in investing. So first, can we have a round of applause for the panel? All right. Should we jump in? Let's jump in. Setting the context. So family offices, very tough for for founders and for fund managers to connect with, and even tougher to identify what part of their strategy, if anything, is venture. So if we could start and go down the line, I'm curious, how does VC factor into your broader portfolio today? Has it changed with market volatility? Are you currently active, sitting on the sidelines? And do you think about it as something that you are consistently investing in or more opportunistically? Please.
Awesome. Thank you so much for the lovely introduction. I think it's always good to sort of set the baseline of what kind of structure our family office is. If in this world we have a saying, which is you meet one family office, you meet one family office. So every single family office is very, very different, as you'll see. So for us, for Lupoff Stevens Family Office, I'm not the family member. It was started by a former hedge fund manager called Peter Lupoff. He started a hedge fund, sold it, and then started managing his own assets. So the portfolio is that we're invested in public and private markets. Venture is a small portion of that, but we mainly invest into fund managers. So we are LPs or limited partners into hedge funds. We invested in an affordable housing fund last year. We are also we have a little bit of exposure in energy, transition, infrastructure, a little bit in private credit. And then most recently last year started getting into venture, which is where I kind of came on board to help diligence our venture funds. In terms of activity, like I said, we just started making our first LP checks last year into both funds and a direct, and kind of continuing to assess, market conditions and creating strategy. We have to be flexible, right, in this market. So it's really hard to say definitively, how much of our allocation we're dedicating at this moment. It's kind of we're assessing at the moment.
Okay.
So for Carmody's, we actually were founded to exclusively invest in venture capital. So Kay stole my line, which is that every family office is different and has their own structure, and is unique and special in that way. So we exclusively invest in venture capital, but that is a combination of funds and direct investing for us.
Yeah, so for our family office, we mainly do direct investments. We do some funds as well, but we're very more of an opportunistic, I would say, allocator. And so we do direct investments to people in terms of trust and the relationships we've built over time. But so we really like to invest in also not only the people, but the purpose and the mission and all of that, because at the end of the day, venture is something that could potentially also change a lot of people's lives. And so in that direction, we do more direct investing.
Yeah. If it's okay if I would add, in addition to Sella, I do advise family offices. And one of the things that I think a lot about is the consistency and pacing. So currently, as we look at what's been a choppy market, my opinion, for what it's worth, is the import of staying in the market. There are great vintages. There are choppy, if bad vintages. But for venture capital as an asset class, in order to actually hit the returns that families are hoping to, it is critical to stay invested through the cycles. Going in and out is almost a surefire way, I believe, to guarantee missing. I'm curious, when building your portfolios, how do you think about diversification versus concentration? And are there areas that you're most interested in, whether it be stage, geography, manager type? We can start the other way if you want, with Louis.
Yeah, for us, because I think a lot of investors like to invest in things that they're already familiar with, or potentially where they also built their wealth. Because I also grew up in different countries, and my family did as well. We like it mainly in the developing countries, so we like to do emerging markets, and also in the U.S. as well. But I think the ethos of our family office is preserving culture. So we like to invest in deals in the U.S. that preserve certain culture. For example, whether that's, let's say, in restaurants, we invest in restaurants. So if, let's say, a family-owned restaurant can't have the financial means to keep continuing anymore, we would like to step in and be like, hey, we would like to preserve whatever you've built here from, let's say, a Japanese restaurant or Philippine restaurant perspective, not because it's an investment, but it's like a culture preservative for it to last for more generations. So in that kind of sense, there's a lot of impact and certain types of deals that we deal that way. Yeah.
We were actually formed 10 years ago next month, and we were initially founded to invest in sports tech. So that is, like you're saying, starting out of a passion. So my dad and my brother were the ones who founded Carmody's, and my brother was finishing up his career as a professional athlete over in Europe, and had seen the world of sports tech and was fascinated by it. And my dad, being a serial entrepreneur, said, we have a unique position to be able to help some of these sports tech founders. So we've since diversified. We invest now in kind of software early stage, so pre-seed through Series A. And one thing I will say is I'm proud that we invest a lot of our capital in the Midwest. And it's really a booming ecosystem. For those of you who are not from Indiana or Indianapolis, this is a really great display of our city. And the work that a lot of the different VC funds and ecosystem players have done to create and build this up is something I'm really proud of.
Can we double click on something you just said for 1 second? So we're talking about how family offices can be the most strategic investors, right? What you mentioned about the sports connection and that your family had a deeper understanding to and ties to that network. Do you think that leads to that component that families themselves are better positioned to put their finger on the scale of an investment versus a traditional LP? If you look at where a family may have made their money, they could accelerate the success of the investment through their network, their business, areas like that?
No, I think that's a really good point. And because traditionally a family office is created out of an entrepreneur who is successful and then is able to create their wealth that way. And so having that operator mindset and having that entrepreneurial mindset is so integral to being able to relate to founders, to being able to, like you said, support those individuals in the unique ways that they need it. And so I do think there's a strategic element there. We also are fortunate to have a little bit of flexibility, and so we get to meet founders that we are personally interested in or in industries that we're personally interested in, and then that allows the relationship to really foster and us to be able to help support them in the long run.
Very helpful, thanks. And Kay, I know you have a very interesting take on this one.
Yeah, definitely. I think just piggybacking off what Louis and Annie said. So as I mentioned before, for venture, the asset class, we have a specific mandate, which is impact investing. And we define that very generously. It's anything positively impacting people and planet with specific interests in climate, social, racial, and gender equity. And that we look at fund managers or founders with sort of a self-professed thesis or mission that their business is built or their fund is built to be able to solve these issues. And I think the beauty about family offices is it's their capital, right? So they can be very intentional with it. And so every year the family has an investment policy mandate that they update. Doesn't change drastically, it's tweaks. But for the duration of the family office, it's always been those themes that the family very much cares about. So we execute on that mission through early stage investing. We've also seeded Fund 1 VC managers, so emerging managers as well. Within impact, we look at sort of two different buckets. One way that the family likes to make their impact is by being capital providers to fund managers and founders who have historically lacked access to that, specifically female and BIPOC-led fund managers and founders. And then the second is kind of what I mentioned before, is more thematic. It's around the climate, social, racial, and gender equity.
Off of that, all three have mentioned investing in funds and investing in companies. And as families think about portfolio diversification, there is that balance to be struck between where are you picking fund managers, where are you picking companies. Curious, we'll start with Annie now, right? How do you think about that diversification?
I think that the diversification choices or strategy that we have when it comes to investing in funds versus investing in directs has really just depended on the life cycle of our office, of where we've been. So in the initial formation, the investment into fund decision was very strategic to be able to build these relationships. Something that all of us believe and have said is that family office, the industry is very relational. And so that was a big part of the strategy of Carmody's early on, was to help build these relationships. And so we invested into some funds for the hope that we would build those relationships, would learn from other people. I always like to surround myself with people who are smarter than I am. So I always want to be continuously learning. And then there's opportunity for co-investment as well. And then once they got their feet under them a little bit, it was a little bit more comfortable to be able to invest in directs. And so they're complementary, but depends on where we've been in our life cycle.
And Louis, before you answer, if I could add this one component. So the one thing I learned in law school, the single thing I learned in law school, is that the answer to every question is it depends. And that, I think, echoes what the panelists said on every family office is different. Because they're different, each one has to define ROI. What is ROI for each one? What does success look like? It's not purely financial returns always. For us, there's 3 buckets: financial, strategic, and impact. Louis, when you think about this idea of fund versus direct, how does it connect with your family's office definition of ROI?
Yeah, so our family office is a little bit more of a helicopter parent. I don't know if that's... we like to be hands-on. We like to see things from where they're at, and we like to really build and really see the intention of the GPs that we're talking to. One example I could probably give is earlier in my days where I wasn't necessarily in the strategic decision-making processes of our family office. I was the note taker for my dad. No one knew that I was his daughter. But I was sitting on deals, and when different GPs were pitching to my dad, I realized that the consensus of everything is people. One GP was they're selling the mission, they're trying to sell as much as they can, which respect to all of that. But the other GP was more about the storytelling and how he wishes the world to see at a better stance. And so coming from that, it was kind of obvious that my dad was like, the second GP was much more of a mission-aligned person, and alignment is super huge within family offices. So he went with the second GP, and through that I learned the power of not only storytelling, but being able to serve a bigger purpose than just the returns and what the ROI is. Because at the end of the day, you are also investing in people, not just the monetary value.
If I can just add one thing to that, I would say, I know there might be some fund managers in the room, and so the relational component is so important. And the storytelling. I kind of think of the best, or the fund managers that stand out the best, similarly to what I think of the founders that stand out the best. So they are extremely communicative, they're transparent, they're well networked, and usually those are also the people who are kind of unafraid to move quickly. And so that's something that I think, just based on your storytelling comment, I think is helpful, hopefully.
And we always love to talk to firms before they're raising. Having a first conversation to say, okay, let's talk to you about writing a check, can ultimately, if you think about the dynamic, is awkward, right? So if a firm is going to raise and they know they're going to raise, reach out early to a family, and you don't have to ask for money. I'm going to raise in 3 months, in 6 months, but I would love to connect, hear what you're thinking about. Kay, I know you also have a very interesting perspective on this particular question.
Yeah, around ROI, right?
Around ROI and also around fund versus direct.
Yeah, so we're mainly into funds, and Louis made a great point earlier about sort of, I guess one advice too for if you're raising capital from family offices is look at the history of the family office and how they generated their wealth. Like Annie was saying, it was through tech entrepreneurship and as a serial entrepreneur, so has that operating mindset. With the family office I'm at, it's through finance. Peter was a former hedge fund manager, so he knows about investing into other managers. He knows all the hedge fund managers and that world. And so he feels more comfortable going and allocating capital into other managers, right, like himself. So that's the reason why. And we're not, there's no ambition to become GPs or play that role. We view that we like to invest into GPs that we trust and they're capable of doing their job, right? So we're not trying to kind of overstep in that sense. And then in terms of ROI, as mentioned, our mandate for venture is impact oriented, and we do our venture investing through what's called DAFs, or donor advised funds. If you're a fund and you have any kind of impact oriented climate, healthcare angle, I highly recommend you check out DAFs because you can effectively receive LP investments through donor advised funds, which are tax advantage for the capital allocator. And so we use it as a way to de-risk our venture investments because venture investing is highly risky. Again, Peter, the principal of the family office I'm at, is a money manager. So we're always thinking about how to manage risk and how to manage downside risk. And so that's a way where we strategically manage downside risk and still make the impact that the family wants and still make our returns, right? So with 2 seconds spiel about DAFs, basically if the fund or the company closes, you can convert it into a grant, which then becomes a tax write-off. So effectively it's like giving a grant to a nonprofit and it's tax deductible for the capital allocator. So that's kind of how we have structured it. I'm very passionate about it. I think more family offices should know about it because you can use that capital to invest in for-profit entities. And so it's really win-win. Yes. And so that's a way that we're looking at ROI. Again, it's a whole kind of scale from cash grants. The family makes, cash grants where there's 0%. They don't expect any return, all the way to we're invested in hedge funds, right? We're invested in the Millenniums, Brevan Howard, and then in between sort of impact investing. And that's sort of kind of the definition of impact investing is you're expecting a return. You're not maybe expecting the top, 10% quartile of returns and making impact, right? It's not one or the other. It's both, and it's sort of always a sliding scale. So looking at finance not as black and white, good or bad, make money or not. You can still make money and have an impact by helping these climate startups or maybe people who have historically lacked access to capital. So that's how we look at ROI.
That's helpful. I think a question that folks still have is often that disconnect between how do these two-sided marketplaces work with one another. The analogy I often think about is the police station. If you watch Law and Order or any of these shows, and you're in the witness room, and there's the two-way mirror, but one way can see all the way through. The other side, they can't see through the mirror. And that's how I think about family offices sometimes. Without a blanket statement, a lot of them like to be on the side seeing into the room, but the other side can't see through. Many like to kind of stay under the radar, which can make access a little bit tough. So I'd be curious how the panel thinks about how you are engaging with the innovation economy, whether it be platforms to engage with the ecosystem, whether it be communities that you're a part of, whether it be suggestions as to how GPs or founders can actually follow, to what Kay just said, know the family's history. Sometimes that's knowable, sometimes it's not. But I do know that Kay actually has created a methodology, or loosely a methodology. So if we could start with you on this one.
You make it sound so sophisticated. The methodology is
It's
an informal
cool
WhatsApp group.
but still needs to be known.
Yeah. So my strategy, my methodology, if you will, is an informal WhatsApp group, but it's effectively just kind of creating my own community. So my strategy is to connect with other peer family offices, LPs, do like a monthly happy hour where it's actually no sponsors, no vendors, no like cash bar. So you pay like whatever you drink, and you come together and just share insights. And then also do sort of private curated salons where it's smaller groups of folks and bring in a speaker where everybody can continuously learn, because I think that's really important too, and constantly be in the flow of information. So that's why I think also choosing your LPs too is so important, because they're your champions in rooms like that, right? And I see it, and
Can you repeat that, because that was a very key comment.
Yeah. And you said two-sided. It is two-sided. Even though maybe the mirror is opaque on your side, you get to choose who your LPs and your investors are as well. So choose people that will, at the very least, advocate for you in rooms that you're not in. And that should be one of the rules as LPs as well, right? Are they kind of, promoting your fund or promoting who you are, right? Not in a salesy way, but telling your story. And I think that story is really, really important. At the end of the day, every decision maker is a human being. And so, yes, you may have MOIC and TVPI and DPI and have IRR and all these numbers and all these metrics, and your spreadsheets and data room may be perfect. And it's like, who is that person running that spreadsheet, right? Or who is that person managing the people that are running those spreadsheets? Because it does come down to culture, it does come down to people. And again, for us, one of the reasons why we have the impact mandate on our venture asset class is to provide capital to people who have historically lacked access, and to make hopefully a small impact that way, and to help create generational wealth and demographics of people that have historically lacked access to opportunities to be able to do that. And so we're looking at, will this person pay it forward? Do they have high integrity? So those are the types of people that, when I'm in a room, or when, Annie and Louie are in a room, or when your LPs are in a room, will they kind of fight for you and make your case, even without you asking them, right? Like, your story and who you are is just so great, and you operate in such high integrity, they can't but help kind of tell their fellow LPs how great you are, right? So I think that keep that in mind. And yeah, so it's all kind of curated or intentional community building, I would say, is the key word.
And if I were wanting to get in touch with Lupoff Stevens, on the radar, know about that chat group, how do people find out about it?
Yeah, so the chat group is for like family offices, so peer LPs. Reach out to me. Come up to me.
I did just receive an invite to the WhatsApp group officially, so we're in.
Yeah.
I still okay a drink from our last happy hour, so.
Yeah. Cannot underscore the import of talking to other families enough.
Yeah, and it's important. It's coming to things like this, or, feel free to add me on LinkedIn. And we were talking about this earlier, right? Not just saying like, here's all my wonderful numbers and here's my pitch deck, but it's making it personalized. Like, hey, I saw you speak at this event and this resonated with me. Like, even small things like that. And to your point about reaching out before you fundraise, I can't tell you how many cold DMs and emails I get of people just asking for money. And if you think about it, it is kind of like, I don't even know who you are.
Right.
It's like going up to somebody at a bar and be like, will you marry me?
Exactly.
That's effectively what, your investor relations are. It's like, I don't even know your name. Like, you may be a serial killer, right? So keep that in mind. Again, just it's a business that we're in. So just remember the LPs, it's not just like dollar signs, they're not just a bank account. They're people too. We're people too. People on the teams are people too. So just, how would you like to be approached if somebody was asking you for money, right? You would want to know, hey, are you going to be able to, even if it's like $100 to buy something, like, will you pay me back? Like, what are the terms? Like, I don't even know you. What are you going to use it for? So just kind of, keep that thought in mind. And also, I always tell fund GPs and founders you also have agency. You get to choose, right? If you yourself and your product and your vision and your strategy is so stellar, like, you choose who you want to reach out to, and you choose who you want on your cap table or on your team, because it is a partnership.
Well, and to pull the marriage analogy forward to make it really stark, the average life of a venture fund is longer than the average U.S. marriage, right? And that's one fund, not talking about a firm, right? So when you think about who you're ultimately going to be partnering with, the import of diligence and integrity and knowing them deeply before you writing the check is critical, which brings me to Annie and next to Louis for the next question. When a pitch hits your desk, what are the things that are most critical that you're thinking about? TVPI, DPI, signals, non-negotiables.
Look, I think all these benchmarks are great, but at the end of the day, again, like, people are what makes the business. But at the same time, with that echoes, if GPs can properly not only educate, but bridge the gap of knowledge of why you're even coming to, let's say, family offices, or the reason why you're choosing certain family offices. Kay talked about agency. Thinking about what that story could look like, and also bridging the gap between what your story is, but also the knowledge of the business that you're trying to make, or what you're trying to solve. Bridging that two gaps can really help an LP lean in from the early on stage, because at the end of the day, there's just so much yapping. There's not much bridging, and there's not much education, not much connecting about what really matters. And so if you can get the LPs to be on your side, one good way is to really educate on why you're passionate about this business, what makes it tick, that it's worth knowing, to kind of like be like, hey, this is more than just a deal to you. This is also a mission. And so education, I think, is huge. And in order to even have those education conversations, trust has to be built, relationship has to be built. So.
Yeah, I'd say that the stats are important. You know, we're always going to look at those, and they're always going to be a part of our decision. But the non-negotiable that I would say is, are they values aligned with us and with our family? So making those decisions, and two sides of the coin, you know, Kay was talking about the family office groups or communities that we will champion our funds and act as ambassadors for them. But then we will also vet them in those communities too. If there's a potential fund, I get a lot of texts that are, hey, has anyone invested in XYZ fund? DM me. And people will take that chat offline, obviously. But being able to just have a conversation with someone who has had that marriage with someone for maybe 10 to 12 years and can speak to not only how are they when they're trying to raise the fund, but how do they act when things aren't going very well? Were they transparent? Were they upfront? Or did they kind of ghost you for a couple months, maybe a year, who knows? So I think that, again, reiterating just how important relationships are in this industry, and the values alignment, because we're making a decision that we want to represent our family literally for generations to come.
And I don't want to
Make
take.
a quick,
Please,
just
go
to
ahead.
say that I think definitely the numbers are important. Just to clarify, it's stats and like your typical KPIs are definitely important. It's not just about story and people. And one thing that we look at for Fund 1 managers, so let's say you don't have a track record, is what did you do previously?
Yes.
So for example, we made an LP investment into a Fund 1 manager, but again, we look at things at how to de-risk it. And she had worked at a financial institution beforehand and had a good track record there. And she created a first fund under an umbrella of a fund that had like a 10 plus year track record that had already like $1 billion AUM. So even though her fund was, I think, 30 million, small fund 1, from the outset, it's like, oh, you're a new manager, Fund 1, only 30 million. But she had sort of the backing and the ballast and the infrastructure of a larger fund. And so that also played into our decision-making process too. Because I also want to be helpful for people in the audience if they are raising. I don't want it just to be about people and story, but so tactical advice. So look at your career and
Yes.
tell that story of if you are a fund one manager, if you have multiple funds, then obviously your track record speaks for itself. But look at your career, and if it's not a historical financial career, then how can you weave the story quantitatively, saying that this is what you said you're going to do and then you delivered. You said X was your goal and you delivered, or you over delivered. And how can you quantitatively tell that story, right? Whether it's a founder, an operator, or you were in another VC, like what is that storyline that gives us confidence that you're going to deliver on what you say you're going to do, and give us confidence enough to put money to where your mouth is?
I would agree with that 1,000%, and add. And this is something that we do, but I was having a conversation with Brad Feld last night, so I'm going to use his words. These are not my words to describe it, but every VC will tell you, if you ask them how they're doing, sorry, not every, most will say they're killing it. It's great. If you ask them instead, talk to me about your 3 biggest challenges with the company. Tell me about your 3 biggest losses. That gets to be a harder conversation, a more awkward one, but those are the important ones to have with them to understand how they deal with what Kay just talked about, which are the tough times, which are inevitable. When we think about true GP LP alignment, right, before the investment, but also after you've made it, what does success look like? I know we've heard a couple of folks say that they are not helicopter investors. But for the ones that are, what does that continued engagement look like?
In terms of continuous engagement, I would say with LP, so GPs, like I just almost wish that sometimes they don't just kind of wither away with maybe the capital allocation that we've made. And so obviously check-ins are always paramount, but at the same time, kind of even talking about certain fires that they would have to put even before the fires have happened in a very strategic way. And so it's very important for GPs to also update, not only the LPs, but also be supportive of the founders or the portfolio companies that they essentially invest in. I think a lot of founders wish that GPs or LPs really, but GPs mainly, have more of a better advice for them how to even run their companies and like how to go about funding, or just be a sounding board. Because I think a lot of times the founder GP alignment is also kind of disrupted. And so if the founder and GP also have such a good alignment, then that also transfers into the GP-LP relationships as well. And so it starts from the ground up. You can't just talk about the LP and GP alignment, but you also have to talk about how the GPs actually treat their portfolio companies and the founders, because founders really do seek those advice and they really, really need it.
Hot takes. We've got 4 minutes left. Hot takes. End of 2025, looking into 2026. What, if anything, do you expect in terms of change in how family offices engage in venture capital?
Sure, I can go first. So not our specific family office, but I go to a lot of different family office conferences, and I think the one trend that I'm noticing is more family offices will go direct to founders and not as LPs into funds, because they have operational know-how, they have the networks. I see a lot of family offices going into fund of funds or funds to learn, and then once they kind of get how it works, then go direct into companies.
My hot take, I am trying to pull one that is particularly hot. But I would say...
It can be medium.
Okay, it's mild. How's that? Medium, mild. That family offices are very much more leaning into community. So there are groups like the one Kay has formed. There are several different community groups that are what I appreciate about one that I'm a part of that has, I want to say, over 250 people, 80 family offices represented, and the moderator of that group has a very strong no selling policy. And so everyone, yeah, exactly. Like a lot of people are trying to get something from you or sell to you, and sometimes that's not always evident up front until you've invested time and into the relationship. But it's nice to have those communities where you are sort of safe and know that everyone in the space is like-minded. Again, your family office might operate very differently than the person or people sitting next to you, but you know that you're at least coming from a similar background, similar headspace.
Yeah, I don't know if it's a hot take, but from the Next Gen's perspective, I think Next Gens are super duper purpose driven. And so I feel like there would be maybe more, there would be greater risks, greater ability to absorb risk in terms of venture capital investing for Next Gens, because I know I've heard a certain also fund that is investing in climate because the daughter really got mad of how their predecessors were investing in oil and gas. And so we're seeing this shift and change where Next Gens don't necessarily want to invest in the predecessors' investing styles anymore. They want to change into something more eccentric or something more purpose-driven, where they're almost fixing what their parents did in a way. Yeah. But that's not just all family offices. That's certain family offices that I'm in a community with. So that's the trend, at least, that I'm seeing, that there's opportunities there for Next Gens. But that's why treat people how you treat them, because you don't know who the next generation investor will be. Yeah. And certainly from a Next Gen perspective, I've definitely felt that. We don't necessarily go be like, hi, we're the Next Gens. No, we don't do that. So it's like, if you really come forward with treating people how you would like to be treated, there's always fruit in that as well.
And thank you. And I suppose my hot take is 2025, 2026 should be the most exciting time for family offices to actually be investing. I think family offices are the most strategic partners when we have more capital now to deploy, particularly when traditional LPs are not putting it into play, particularly in emerging managers, who, if you're assessing them, as Kay was talking about, we look for repeatable and scalable outperformance. What have you done before? Can you do that again, as we are entering a wave of innovation that we have never seen before because of the conflation of all of these new technologies? So the ability for families to be strategic and come in and get involved in fee-free co-invests, accelerate the success of direct investment companies based on their background and connections. This is a time like we've not seen before. So, to the panelists, you all have been fantastic. Please, can we give them a round of applause? And speaking for everyone, I think it's fair to say we're all happy to connect at any point. A big takeaway is that there are groups that exist to connect with families. So reach out either to us or search within and find those groups as well. And best of luck to everyone. And good luck to the Pacers, as challenging as that may be to say.
Thank you very much, Jeremy.
Thanks, everybody.
Thank you so much.